What is the discount rate? Have you ever wondered how investors decide whether a property is worth buying? One key factor in that decision is something called the discount rate. So, what exactly is the discount rate? It is a rate that reflects the return an investor expects from an investment. This rate takes into account the time value of money, risk, and opportunity cost. By using the discount rate, investors can calculate the present value of future cash flows. This helps them determine if the potential earnings from a property justify its purchase price. The discount rate plays a vital role in a method known as discounted cash flow analysis. This approach assesses the present value of future income streams, like rental income or proceeds from selling a property. When the discount rate is higher, the present value of those future cash flows decreases. This means that investors will requiring a higher return on investments that are considered riskier. Now, how do investors determine the right discount rate? There are several methods they can use. One common approach is the cost of capital method. This involves calculating the weighted average cost of capital, which considers both debt and equity financing. Another method is setting a target rate of return based on expectations for similar investments. Investors can also look at market comparisons, using capitalization rates or required returns from comparable properties as benchmarks. Another approach is the build-up method. This method adds risk premiums to a risk-free rate, such as the yield on United States Treasury bonds. This helps account for factors like market volatility and specific risks related to a property. In real estate investing, the discount rate is essential for evaluating different types of investments. For core real estate assets, which are typically lower risk investments in prime locations, the discount rates usually range from 6% to 8%. On the other hand, value-add investments, which involve some renovation or operational improvements, typically have discount rates between 9% and 12%. Lastly, opportunistic investments, which are higher risk, often requiring discount rates above 12%. The discount rate is also influenced by broader economic conditions and monetary policies. For instance, when central banks like the Federal Reserve change interest rates, it can impact the cost of capital. This, in turn, affects the discount rate used in real estate valuations. As a result, these changes can influence the attractiveness and pricing of real estate investments in the market. Understanding the discount rate is essential for anyone interested in real estate investing. It helps investors make informed decisions about the potential profitability of their investments. By keeping an eye on the discount rate and its relationship with economic indicators, investors can better navigate the real estate market.